Right, so I think we're going to get started. I'm going to introduce our moderator for this panel, Don Nisanoff of Capital Markets Advisors. Don, do you want to take it from here?
Sure. Good morning, and welcome to the LIBOR Replacement Roundtable discussion. My name is Don Nisanoff. I'm a partner with Capital Markets Advisors, and I'll be the moderator today for our esteemed panel of experts. I'll just begin now with a few opening remarks. The transition from LIBOR to the Fed-published secured overnight financing rate, or possible alternatives, is a multi-step process in that the benchmark is so deeply embedded in the documentation, operations, and culture of all manner of companies and financial institutions. First, to effect the transition, references to and use of LIBOR must be identified in the company's documents, which takes on added import when those docs are interrelated, as are the systems and operations governed by them. Second are the operational challenges resulting from the use of a new benchmark, including impacts on risk management, pricing, and adjustments to cost of credit, among others, and the importance of accurately mapping new data to the proper functionalities. There can be no stale data flow. In addition, documentary modifications across the entire enterprise must address all of these changes, a major undertaking. This, of course, is in addition to tax and accounting changes, state, federal, and non-US legislation governing ongoing use of the new benchmarks, and policy changes in complex industries that depend on effective governance and well understood guidance. This transition is a challenge to all members of multiple industries, and in this initiative, preparation is all. Our panelists will be addressing each of these areas in systems, contracts, policy, and innovation, and we look forward to an insightful, dynamic, and practical discussion from our panel of experts. And now I will sort of introduce our panelists, and we're very pleased to have such an impressive list. First, and this is the order in which they will be presenting. We have Meredith Coffey, Loan Syndications and Trading Association, the LSTA, Executive Vice President, Research and Public Policy, and Gabe Gross, IPRO, Strategic Client Manager, Paul Michaud, Capital Markets Advisors, Partner and Head of CMA Canada, Jamie Kane of the law firm of Eversheds-Sutherland, Partner for Corporate Transactional and Regulatory Compliance, Charles Wambua, Automated Financial Systems Inc., AFS, Senior Project Leader for AFS Vision, Syndications, and Capital Markets, Jim Shanahan, CoBank, Vice President, CFA Financial Regulatory Compliance, and Matt Beers, Bank of Hope, Senior Vice President and Head of Loan Operations. And now to our panelists. And one thing I will mention, though, if you do, audience members, have questions, if you could save them for the end, we'll make a note of it, and we'll put them in the chat, and we'll address them during the Q&A and following the panel presentation. Now for Meredith, our first speaker. Meredith is EVP of Research and Co-Head of Public Policy at the LSTA, the trade association for the U.S. syndicated loan market. Meredith heads the LSTA's LIBOR transition effort, is a member of the Alternative Reference Rates Committee, which I'll refer to as ARC, co-chairs the ARC's Business Loans Working Group, and is an active member of the ARC's Securitization Working Group. Long story short, says Meredith, she has lived, breathed, and dreamed LIBOR for the last 3 years. Meredith?
Great. Thank you very much, Don. And thank you, AFS, for inviting me here today. What I want to talk about today is three major things. I think this will help level set for the rest of the roundtable. The first thing I want to talk about is, one, where are we in the LIBOR transition today? Because it can be very confusing. It's a fast-moving and changing story. Two, what the potential replacement rates are in the US and how they compare. And then three, what those replacement rates do or don't do for you if you are a lender or a borrower. I'm hoping this will help frame the rest of the conversation, the roundtable. So maybe going on to the next slide, let's start off with things to know. And I want to make several points here. The first point I'd like to make is what's going on in the US and what's going on outside the US is different. So if you look at the first bullet point, if we focus on non-US dollar LIBORs, everything ends at the end of this year, at the end of 2021. At the end of 2021, there must be no more LIBOR origination in non-US dollar currencies, and all non-US dollar LIBOR currencies, or not all non-US dollar LIBOR exposures, must transition to replacement rates on December 31st, 2021. So we have a big bang going on outside the US. In contrast, if you look at the second bullet point, what's happening in the US market is a little different. We have a bifurcated process. US dollar LIBOR origination must end December 31st, 2021, so no new LIBOR originations starting 2022. However, the transition for US dollar legacy contracts is not required until June 30th, 2023. So if you did a loan on December 25th, it could be on LIBOR and not transition until June 2023. If you did a loan on January 2nd, 2022, it must be in a replacement rate. So we've got that bifurcated process. As we drill further into the US market, several replacement rates are in play in the US syndicated loan market. The US loan market is somewhat divided between SOFRs, and particularly forward-looking term SOFR, and credit-sensitive rates. These credit-sensitive rates include Bloomberg's BSBY, Market Credit Spread, AFX's Ameribor, ICE Benchmark Administration's Bank Yield Index, and AXI. So these are all in play right now. This tension should be resolved in the coming months. However, that said, we are likely to be in a multi-rate environment for years and possibly permanently. Certainly by the end of this year, we're going to have existing loans in LIBOR and new loans in either new loans in a replacement rate, possibly more than one replacement rate. So we will be in a multi-rate environment. People need to prepare for that. And then finally, I would point out is that there are economic and operational implications for the different replacement rates. We focused a lot on the operational differences in our work in the last few years, but there are economic differences as well. So let's drill into these rates. John, perfect. Go on to the next slide. So what I want to do is talk about, what LIBOR is and how it looks, and then what the potential replacement rates look like in sort of descending order from most like LIBOR to least like LIBOR. So if we look at LIBOR, I'd say there are three characteristics we focus on. First, LIBOR is credit sensitive. It reflects banks' cost of funds. Second, it is a forward-looking rate, and it is a term rate. Third, where you've got what's largely used in the syndicated loan market, 1 month LIBOR and 3 month LIBORs that are known in advance of the interest period. If we look at credit sensitive rates, again, like BSBY, Ameribor, Market, Bank Yield Index, and AXI, credit sensitive rates are calculated using market information, often by looking at things like, what are the CP and CD rates of banks, what are the bank deposit rates, what do bank bonds yield. So they are calculated using market information. They look much like LIBOR. They're not forward-looking, but they are credit sensitive, and they naturally have 1 and 3 month tenors. So again, very similar to LIBOR. SOFR is the secured overnight financing rate. It is an overnight risk-free rate tied to overnight treasury repo. It is risk-free, so there is no credit sensitivity there. And it is overnight, but a 1 month or 3 month tenor can be created by either averaging the daily SOFR rate, so you can do this in advance or in arrears, or using a term curve developed by futures trading. So these are the rates that are in play. What I want to do is go into this grid and talk about some of their characteristics, use cases, and strengths and weaknesses. So starting out at the very beginning, obviously we've got LIBOR, that is the state of play today. LIBOR is known in advance the interest payment. It does not, or interest period, it does not require significant calculations. It is credit sensitive. It's used almost universally, but its weakness is that it goes away at the end of this year. So that's the universe that we're comparing ourselves to. If we go a little further down and look at credit sensitive rates, again, these are modeled or structured to look like LIBOR. So they are known in advance the interest period. They do not require significant calculations, and they are credit sensitive, all similar to LIBOR. The current use cases, they were developed for loans, but we have had a BSBY, for instance, FRN being issued. So we have seen some bonds coming off them as well. The positives, the strengths are, it's a nearly seamless substitute for LIBOR. Fits into systems well, the economics are similar, it's pretty seamless. However, The weaknesses are it may be more fragile than SOFR. It is definitely using fewer less underlying data, and the underlying data may be impacted by money market reforms. So there's some unknowns out there. Going further down, the rate that's next closest to LIBOR is forward-looking term SOFR. So forward-looking term SOFR is built off SOFR's futures trading. So basically you bootstrap a futures curve. It is known in advance the interest period. It does not require significant calculations to be functional, but it is not credit sensitive, so the economics will vary. It is already being used pretty extensively, almost universally in hardwired fallback language, but it is not being used to originate new loans or new FRNs yet. This is because while the CME has published a licensable term, forward-looking term SOFR, the Alternative Reference Rate Committee has not yet recommended it for use. On the positive side, it does very easily substitute for LIBOR in loan systems, but again, from a weakness perspective, it has not yet been recommended by the ARC. Going down to the next one, SOFR compound in advance, again, has some similarities with LIBOR. This is where you calculate the SOFR rate looking backwards. So you would calculate a compound average of SOFR for the last 30 days or for the last 90 days. You would freeze it and lock it and apply it to the interest rate going forward. So it is known in advance the interest period. It does not require significant calculations. It is not credit sensitive like all the SOFRs. It is currently being used in mortgages and RMBS and may be picked up more broadly in ABS generally. It is robust. The underlying data is very, very significant. It easily substitutes for LIBOR in loan systems, but it's a backwards looking rate. You're looking at the previous period. So it is viewed as stale, and many lenders feel that it could be arbitraged by commercial loan borrowers. So there's not been a lot of appetite for it in the lender community. Those three rates, credit sensitive rates, term SOFR, and SOFR compound in advance, are pretty similar to LIBOR. The next two rates, daily simple SOFR and daily compounded SOFR, are pretty different. So these rates, first of all, are not known in the advance of the interest period, which means systems have to change significantly. For daily simple SOFR, you're calculating the interest rate during continuously along with the interest period. Every day you pull the daily SOFR, you divide by 360, you multiply that by the principal, and that's your daily interest accrual. So it is not known in advance of the interest period. However, that's a pretty simple calculation. Simple calculations are not required. It is not credit sensitive. It has been used on some business loans already and in some FRNs. Its positives are it is robust and relatively easily hedged. And it is more implementable than daily compounded SOFR, but it does not easily substitute for LIBOR in loan systems and conventions because it is this daily rate. And then the final rate I would flag is daily compounded SOFR, which is least like LIBOR. It is not known in advance of the interest period. You pull the rate on a daily basis, you divide by 360, and you take that rate and you start compounding it every day to calculate sort of your daily compounded SOFR, which you will know at the end of the interest period. So it's not known in advance of the interest period. Significant calculations are required. It is not a simple thing to develop a non-cumulative compounded rate, and it is not credit sensitive. That said, it is the standard for derivatives. It's the standard for most FRNs. And then it is what is being used in other jurisdictions. Now, to be fair, it is very robust. It is very hedgeable. It's what's being used for derivatives, but it is a challenging substitute for LIBOR in loan systems and conventions. But that's roughly our solution set. The last thing I would say before we go on to the next slide is if we look economically, LIBOR and credit sensitive rates are going to be pretty similar. They're going to be similar and relatively high. SOFRs are all going to be similar relative to each other, but they're going to be generally lower than LIBOR and credit sensitive rates. So this is going to mean that the economics are different in that world. Going on to the next slide, I will wrap this up by flagging two key characteristics that is probably worth folks thinking about when they think about credit sensitive rates and known in advance SOFRs. What's critical, I think, is to say, what do you need in an interest rate? Do you need to know the rate in advance of the interest period? If you only are interested in knowing the rate in advance of the interest period, both credit sensitive rates, term SOFR, and SOFR compound in advance let you know the interest rate in advance of the interest period. Because of that, they operationalize much like LIBOR today. Trading doesn't change if you trade your loans. For the borrower, cash flow forecasting doesn't change. Certainty doesn't change. Notices don't change. So again, if you're more focused on the operational aspects of a known in advance rate, you can either go with credit sensitive rates, term SOFR, or SOFR component in advance. In contrast, if you're very focused on that credit sensitive component, only credit sensitive rates have a credit sensitive components. SOFRs do not. So economically, credit sensitive rates do not require spread adjustments to maintain economics, and that credit spread cannot be competed away on credit sensitive rates because it's embedded in the reference rate. So again, we think it's very important for people to figure out what they need, and then they can figure out what rate makes sense for them. In conclusion, I would say as we go forward and we begin to see non-LIBOR originations that are likely to pick up very significantly in the second half of 2021, we think everyone should think about many things, but I would flag three major things. One, know the rate alternatives that we talked about on the previous page, know their strengths and weaknesses, know what you need and what you don't need in an interest rate. And this will help you select the rate that is most appropriate for your needs. So Don, I hope that was a helpful sort of overview as we go into sort of a deeper dive into how we solve for these rates. And maybe I can turn it back to you.
Yes, it was. That was great. Thank you, Meredith. Our next speaker is Gabe Gross of IPRO. He'll be discussing ideas on leveraging technology to identify, understand, and sort your existing LIBOR agreements for remediation. Gabe?
Thank you, Don. It's an honor to be here with such esteemed panelists and for such an important conversation. Just generally as an further introduction, at IPRO, I help organizations interact with data differently by gaining transparency and increased collaboration at every stage. And so as Don said, today I'm going to talk about three ways in particular how technology can help with the challenges associated with the LIBOR transition. So the three ways in a broad brush are identifying the universe of agreements in your network that may have LIBOR exposure. What's that total universe? Once you have that total universe, the next step would be understanding which of those agreements really might need remediation. And when you have those, the third step will be to prioritize, to sort, to tag, to really prepare what you need for final remediation. So for the first step, understanding the universe, what we and other technology can help you do is connect into all your data sources and search all of your documents in place, whether they're in shared drives, maybe they're even sent through chats, or wherever they're stored, and look through the metadata, look through the text, and see which might be potentially responsive to being in need of review and remediation. And so that's bringing in the universe. The next step would be bringing some definition to that universe. So it's always helpful to have, and this is a screenshot of our platform, some graphical interfaces that give you literally a picture of what you have. And that picture could be by concept, it could be by custodian, it could be by date. And in the lower right, for example, you'll see what we call a heat map where you can coordinate against two of these characteristics to see, for example, which custodian has which type of agreements, the most of which type of agreements, or the most of a certain concept or keyword. And being able to do this enables you and all of the teams involved to really get on the same page and start to collaborate together. You know, this kind of efficiency reduces the need for handoffs. It allows everybody to understand the same set of facts and be able to make some really important strategic decisions around what is the true scope of what's ahead of you, how long will it take, what budget do you need for that. That will all be gained at this stage. And then we move on to the third stage. And the third stage is really of two parts. First is using artificial intelligence to prioritize what's in your universe. And this will accomplish three things. It'll reduce the time by surfacing time needed to complete the project, by surfacing documents that are most likely in need of remediation, similar to maybe your experiences on Netflix or Pandora, where your behavior of what you like, what you find important, what you spend time with, will then have the artificial intelligence surface, well, you thought this was important, this document in our example, then these documents are the ones you might want to look at next. Technology can also help you reduce errors. And ways that it can do that, for example, are grouping documents together by concept or other types of similarity to other documents. And what that does is when you have the same person looking at a similar set of documents all at the same time, the likelihood that two similar documents get treated differently gets reduced, right? So you're lining everything up, you're increasing efficiency, and you're reducing the likelihood of errors. Now, of course, both reducing time and reducing errors can save costs, both in the near term of less cost to get through the project, and in the long term of any potential exposure left by making errors during this process. And then the second part of the last stage is final tagging and sorting for remediation. So here's a look at a document loaded into our review, and you can have different keywords already pre-highlighted to show you where they are in a document. You can still do further searching, but on the right side of the screen, what you see is a tagging palette, fully customizable. And here's where you can say, okay, well, this is whatever type of document it is, whatever type of provisions are in it, whatever type of remediation needs to happen. And again, specific to your project, your documents, and what's important for your workflow. So in summary, these are the three ways that technology can help solve some of the challenges associated with the LIBOR transition. Understanding the potential universe of exposure, bringing some clarity and picture into what's in that universe, and then prioritizing and sorting for final remediation. I'll be glad to answer any questions in the Q&A session after. I hope this was a helpful introduction to some of the ways that technology can help with these challenges. Don, back to you.
Thanks very much, Gabe. That was excellent. Our next speaker is Paul Michaud of Capital Markets Advisors. And the question that Paul poses is, so what happens after you decide to replace LIBOR and what you plan to replace it with? Paul will be discussing the implications of replacing LIBOR in a broader context, including implications for systems, data, analytics, and operations for secondary markets. Paul?
Thanks, Don. Jonathan, if you can bring up the next slide, please. So, as Don mentioned, I mean, what I want to talk about, and the question that always comes up for me and with a lot of our clients is, okay, we're changing LIBOR, we're going to another rate, we've made that decision, whatever that decision happens to be, now what? Some of it, is what Gabe alluded to. There's the entire process of figuring out, what do we have to change from a contract document perspective, but that's only a piece of it. What I wanted to sort of bring up and sort of highlight to people is there's an awful lot more that's touched by LIBOR, and particularly in the secondary markets where I spend a lot of my time. It's everywhere. It's not enough to figure out what you originated. It's not enough just to find the contracts. That's absolutely a necessary step. But we have to remember that LIBOR goes into computing the price of an option in most firms, even though it's on a stock that has nothing to do with LIBOR, right? We use LIBOR as our risk-free rate in a lot of derivative calculations. And if we go to SOFR, you need to know that this is going to be an automatic change in the valuation of every derivative in your portfolio if you don't have an adjustment to get it to the same rate level. This goes into our risk calculations. It goes into our credit risk. It goes into absolutely everything. And the concern that I have and what I see with a lot of the focus and even with our panel here today, a lot of people are worried about origination aspects and the primary markets, but it's important to understand sort of how we look at this after the fact, right? How do we determine in a trading system or a position keeping system? So fine, using the technology that Gabe described, we can identify all of the contracts in our document repositories and our shared drives, et cetera, which is critical. But now you got to figure out what thing in my database actually is this, right? In a simple environment, when working with things like loan origination, or AFS has some great capabilities for this, in their system to make that relationship. But when we get into the more complex world of, say, the large tier 1 investment banks who are wrestling with this, or even the tier 2s and tier 3s on the capital markets side, actually mapping between the physical paper contract into the potentially 250 trading systems we have distributed globally is a non-trivial task. And actually performing that exercise and making sure you know what it is and what rates and so on is not insignificant. Even things like, if we want to determine cash flows to price a bond, we run analytics and create curves for discount curves and zero coupon curves and all kinds of curves. And a primary component to every one of these analytics is LIBOR. That bond may have nothing to do with it. So bond may not price off LIBOR. It may not pay out coupons based on LIBOR or anything. So your search for contracts or in your database is going to show this bond has zero relationship to LIBOR. But the way you price the bond is actually being fed LIBOR rates, right? So you need to be able to think about all of these things and how they play out. Currently, a lot of our clients are doing work for the big regulatory change for FRTB, which is going to impact capital significantly. Well, the reality is right now, when it was originally specified, FRTB as a whole bunch of credit rates, which in pre-LIBOR, when the reg was initially written and drafted, would have mapped into LIBOR risk buckets. Well, what's that map to today, right? And these are all things that you need to think about as you go through this process. And so it's really critical that people not think that this ends at simply picking a rate and identifying what contracts they need to repaper. There's a lot more to it, right? Your operations and making sure things go correctly. Again, in the primary market, right, you're going to have to do your rate calculations, and that's great. The problem is, again, potentially exacerbated in the secondary market. What happens if I own a mortgage-backed security with a pool of mortgages that are 25 years out that may be floating rates against LIBOR, and I may or may not know what every one of those was changed to in the pool, and now I have no idea what cash flows and how I'm going to get paid and what the value of my mortgage back is, or a CDO or something like that. So again, these are some of the things that I would challenge people to think about as they go through this, and just make sure that they don't sort of end at the point they identify and repaper the contracts. That's clearly significant, but there is much, much more to it, again, particularly as we move into the implications for the secondary market. I'll pass it back to you, Don.
Thank you, Paul. That's great. A lot to think about. Our next speaker is Jamie Kane, a partner with Eversheds-Sutherland, and he's been monitoring and advising a broad range of financial institutions, including several GSEs, insurers, broker-dealers, and multinational commercial companies, on the demise of LIBOR, its implications, and the transition of their public debt, loans, and investments to other rate alternatives. Jamie?
Thanks, Don. Could I have the next slide, please? What I'm going to talk about is going to take us, I think, maybe back up to 50,000 feet a little bit as far as what we've got to be thinking about, and I'm going to focus on a few of the things that Gabe, Meredith, and Paul have already spoken about, but maybe give it a little bit different context. And those include just sort of general LIBOR considerations, transition planning, which you're going to hear a lot about today, and what you can do and who you can use to do such planning. And talk about the fallback language, which again, Meredith already touched on, but I'm going to talk about it from a slightly different perspective and talk about various other cash products and derivatives. We'll talk about the legislation, which you probably have heard about in New York, and the potential for federal legislation, and some of the tax and accounting issues that are the sort of thing along the lines of what Paul said that you got to be thinking about whenever you're considering what to do in connection with this transition. So next slide, please. Okay, now, this is certainly not, none of the things that I'm going to be talking about are a definitive list, but these are many of the things that you should be thinking about. And quickly, at the top of the list is, okay, let's say you've got a LIBOR contract, there's no fallbacks. What do you do? Should you care? Well, you've got to worry about lawsuits, frankly, disputes based on claims of contract, frustration or impracticability. There could be breach of contract. Someone would say, for example, that there is some sort of LIBOR that's still being published and you have to use it even though everybody else has transitioned away from it because the government regulators have said that it's not a sufficiently liquid and transparent rate. You've got to be thinking about these legal issues. And that kind of drops down to the last bullet on this slide, which is the so-called tough legacy. Those are the ones that you've got in your portfolio that don't necessarily have a mechanism for transitioning over to LIBOR. And there's going to be a cost associated with that. Even if people are not successful in pursuing claims against you, there's going to be a cost to the extent that they do. The second major point, and when you look at these various things that talk about the types of fallback rates that you could use, and looking at things like Paul said, you have to look at not just what the basis for the rate is, whether or not it's simple SOFR or compounded SOFR, or you're using Ameribor or BSBY. You have to look at what spread adjustment methodology there is, which there often is, in particular with compounded SOFR in arrears. You need to know how this is going to affect your hedges, not just from a financial perspective, but also from an accounting and tax perspective. What your clients are how they're going to react to it, and the need to educate them about that. And of course, there's a myriad of laws that you have to take into account when considering, what exposure you have and what your solution is going to be. Next slide, please. So you'll hear this in various forms today about what I call the 3 steps of the transition. And you'll see flow charts with AI and different people involved and different considerations you should make. But everything always starts with scoping, figuring out what your exposure is. And I think the biggest advice that I provide to our clients is, with respect to scoping, is try to get everyone at the various stages involved in scoping. You can't have someone scope what your exposure is and look for something and then bring in somebody else to come in and provide a solution, because they may not have the information necessary to provide the solution because it wasn't scoped properly in terms of the information that you obtain. Likewise, there's a lot of back office that has to be involved in this, and not knowing what they're concerned about in terms of the implementation, for example, even if there's no bilateral negotiation, you're just merely changing systems. You need to know upfront, what you've got, and that's critical, and it really does involve all the people. I'm not saying every single person, but you have to have people from the various teams that are handling these stages. Scoping. The other issue that I think that gets lost in the shuffle sometimes is people go out and they find out what all their LIBOR exposure is, the various contracts, cash products, derivatives that have LIBOR exposure, but they don't prioritize, in the sense that there's got to be some things that you don't care about, because they're going to mature, for example, before for dollar LIBOR before June, the end of June in 2023. You might also say to yourself, I'm a taker. I really don't have a dog in the hunt in the sense I'm going to have to take whatever is given to me. Now, that all said, that is a very bad position to take, because as Paul was talking about, there are going to be financial impacts with respect to what your LIBOR exposure is. And one of your solutions, even if you're a so-called taker, is to the extent you've got an instrument, for example, a bond that's based on LIBOR and has a fallback to compounded SOFR and arrears, or does not have a fallback, is to get out of it, to sell it. And you need to know what the financial impact is with respect to the solution that's embedded in that investment, or the lack of a solution. You need to know, for example, too, whether or not someone's going to be exercising discretion and how that discretion is going to be exercised, because that could be an unknown in terms of what your what your exposure is. So again, the main point here is get people from all the teams involved in your scoping process. Realize that even if you're a taker, there's going to be exposure that you could deal with in some way, shape, or form, and you need to understand what the financial impact is going to be, both in terms of just the mere economics, but capital, as Paul pointed out. And the solution that you develop is going to vary based upon the type of instruments across the board. Our clients, as Don alluded to, are really pretty broad spectrum. The GSEs are the largest issuers of both secured and unsecured debt in the U.S. And depending upon the product, whether it's unsecured debt or secured debt, there could be a different solution that they've had to utilize. Likewise, you're going to have different solutions for loans, different solutions for securitized products, and then different solutions for derivatives. And there's going to be subsets within each of those categories. And then the implementation phase, of course, is critical, and it sort of emphasizes why you have to be doing something now. You can't wait any longer. I'm assuming most of the people on this call have gone through some sort of scoping already and are thinking about their solutions. But if they haven't, there's no time to waste at this point in time. Next slide, please. Okay, this slide is a little different than the Meredith slide. And this sort of talks about the existing fallbacks that you have in various cash products. And by cash products, I'm including different types of loans, different types of bonds, securitizations, and derivatives. And the bar sort of goes across, what you might find. And again, this is not meant to be the universe. It's going to vary. And this is why scoping is so important, to find out exactly what's there. But that's sort of what you've got right now, which is leading for the need to have, a transition. And then the bottom sort of covers what some of the more commonly utilized fallbacks have been so far. And just to focus on a couple of these, I get, one of the examples that I've had some direct opportunity to work with is, what do you do with a bond that basically has a fallback, which is very typical to the last published rate, which is, let's say, the last published LIBOR, which, as you all know, is extremely low right now. And if there was a long maturity on that, people are not going to be happy on the investor side if they're getting only 18 basis points on their debt, maybe even with the spread over the next 20 years. So what do you do about that if there's no mechanism to amend the document, and other than going out to each investor and getting the amendment, which is also very typical in a bond, that if you change the interest rate, you have to go out and get each investor's permission before you change the interest rate to something else. And if there's discretion, the question is, okay, what do you do in terms of picking an alternative? Are you going to get in trouble if you go to something other than what the ARC recommends, with respect to compounded SOFR and arrears, for example, for LIBOR, versus going to a Mirabor or BSBY? So, those the considerations there is, like, what is the process for the fallback or the absence of a fallback, and then what are your alternatives? The derivative space is actually the one where they probably had the most success in that they also had a fallback that went back to something that was really not workable, which was getting quotes on LIBOR and the various other IBORs. And they came up with what they've done in other circumstances where they have to amend a wide range of documents. They came up with a protocol which allowed people to basically agree to the protocol, and then anyone else who agreed to that same protocol would amend their documents to include a fallback, which in the case of US dollar LIBOR was SOFR SOFR compounded in arrears with an adjustment spread. That's one thing I didn't want to focus on, because Meredith had mentioned, compounded in arrears doesn't have a credit component. There is a component in there to try to take that secured overnight rate SOFR and make it more like an unsecured LIBOR rate. And that was an adjustment spread, which is based on a 5-year look back, which was sort of done from March when they announced that the end of SOFR was going to take place either at the end of this year, depending upon the tenor, or in June of 2023. So there is that sort of adjustment spread that is built into the spread, which is intended, into the rate, which is intended to address, in some respects, the credit aspect, but it's static since it was set in March of this year, and it may not be good going forward. So I mentioned that those types of spreads are also key to this, and that also you can always add a spread to add a credit component, even in terms of an overnight secured rate, which can make it something a little bit more akin to what you've got in the other forward-looking rates, such as Ameribor and BSB. Okay, next slide, please. Okay, we've all heard about the legislation, and you might all think, oh, no, our prayers have been answered. We've got a solution. What this solution does is, at least for instruments governed by New York law, which is the vast majority of financial instruments, at least in the US, with the US dollar LIBOR, you've got a law that basically says that if there is an inadequate fallback, and by an inadequate fallback means one that does not have a fallback to another rate, such as prime, or a rate that is not based on LIBOR. If it's a LIBOR based fallback, including, with, for example, going back to what I said on bonds, the last fixed rate, or it goes back to LIBOR quotes, that's inadequate. If you have an inadequate fallback, essentially what happens is, by operation of law, your contract, your instrument is amended to include the ARC recommendation, or if you choose the ARC recommendation, you'll be within the statute. With respect to instruments that allow for discretion in picking a rate, it basically says that, to the extent that you pick an ARC recommendation, then you will not be subject to liability or suit. So even though it doesn't say you have to pick that rate, and you can pick something else like Ameribor or BSB, you're not necessarily going to be protected from liability from doing that. The New York statute has limitations in that it's only it's only good for New York. Paul mentioned pass-through mortgage securities, where you have a pool of mortgages from many states. If you don't have a law in those states like New York's law, you're going to be back at that first bullet that I mentioned, where there could be suits for frustration of purpose or impracticability or breach of contract and the like. So you're not really in a good place. Could you go to the next slide, please? So what's happened is, there are other states, including Alabama, so far has passed a law like New York's. You're going to have to look and see if other states have those laws, or there could be a federal solution. And there has been a proposal that is circulating around Congress right now, and there was a committee hearing on that in April, which are basically, at the current language, adopts the New York solution. It would preempt all other state laws, including New York's law. And I mentioned, while it does look like New York's law and goes back to an ARC solution, a SOFR-based solution, during the hearing, while there was general agreement by the Congress people that were on the call or at the meeting that some sort of solution was necessary, they weren't wed to the fact that it had to be an ARC-based solution using SOFR. So that's something we'll have to see. The EU and the UK have also got their own solutions in place with respect to transactions governed by either EU or UK law. So you need to be thinking about those other jurisdictions as well. And then finally, I'm just going to touch on the last slide, please. You hear a lot about, well, what about the tax and accounting issues? There's a couple of things out there that were intended to facilitate the transition. On the tax side, there's a proposed regulation that's out there right now that allows a transition to enumerated rates. And even if they're not enumerated, if it's not SOFR or one of the other rates that they've listed, you can also use a reference rate, so long as you can prove that that it's the market value is effectively the same. So that's the solution there. And the accounting side, in order to avoid issues with respect to implementing the ARC solution with spreads and the like, they basically created a safe harbor that if you go with the ARC solution, that you're going to be in a situation where you're not having a recognizable tax event by going with the ARC solution. On the FASB, sort of done the same thing. They haven't come up with specified benchmark rates, but they do require an analysis, as to the economic equivalence of the use of a particular rate. There are, in other words, there are gating issues just like there are on the tax side. One of the big issues with the accounting solution right now is that it's only good through December 31st, 2022. As we all know, the extension of time to June 30 of 2023 for many of the USD LIBORs is not within that time period. There is a FASB meeting in June, and they're going to try to get an extension of time, and also get some additional clarification. One last thing on the accounting side, even though it was focused on LIBOR transition, they recognized that SOFR utilization was part of that, and so they also provided a safe harbor for cleared instruments to the extent that the clearinghouse was using for cleared swaps, for example, for price adjustment amounts or price alignment interest using effective funds, federal funds rate, and that was transitioned over to SOFR. That also was given preferential accounting treatment, just like the other LIBOR transition events. That's it from my end, Don.
Thank you, Jamie. That was a great range of information. Our next presenter is Charles Wambua from AFS. AFS is a fintech provider of syndicated and commercial lending solutions. There are over $3 trillion in lending assets running on AFS solutions. Charles will focus on the elements of operational systems readiness. He'll also present some results of market surveys AFS has conducted regarding readiness in the syndicated and commercial lending domain. Charles?
Thanks, Don, and good morning, everyone. Let's go to the next slide. So AFS has worked extensively with Meredith and others on the ARC Business Loans Working Group to make sure that we all have the same understanding of the new SOFR conventions, and they can practically be operationalized from a day-to-day working capacity. So I'll be going through some of the conventions we've heard or concepts that we've heard from that business loans working group, and to also focus on, can this really work from the banking side? So on my first point, as Gabe, Paul, and others stated in their presentation, one of the very first things that everyone in operations needs to do is analyze their whole portfolio to identify the loans that reference LIBOR and to look for easy tech solution on how to amend them, right? So that's not an easy process if you do it manually. Also, the agent banks need to understand their client's business to help recommend the best SOFR variant, which fits their model. So for example, in a business where one is constantly getting excess cash flow, and so they're constantly paying down their loans in the middle of a cycle, then it would be best for those borrowers to use compounded by balance method as opposed to compounded by rate, due to the complexities in the calculations and tracking of unpaid interest on interest. And if we throw in trading, then it even becomes more complex as position is moving from one counterparty to the other in the middle of interest cycle. On my point number two and three actually go hand in hand. Introduction of new functionality on an existing platform can sometimes cause existing structures to malfunction due to new code clashing with the old one, right? So we need to be cautious as we implement, not to inadvertently disrupt existing accounting measures. On point number three, as a vendor, the ARC gave us a deadline to be ready by September of last year, which AFS did. During that time of development, we had to do extensive testing to meet the ARC conventions. And now, because now we've delivered to our clients, banks are testing their systems, including ours, so not just AFS, but all their systems, to make sure that they meet their internal standards. So the banks have their own standards based on their credit agreements, but those standards may deviate as they transition, may deviate from the ARC conventions in some cases, because the ARC is not enforcing their conventions, they're only making recommendations. So the banks internally have to look at their models and make sure that the system or the code that was delivered actually can support their loans after LIBOR ceases. At the same time, collaboration between vendor systems is crucial. For example, a loan trading and servicing system like FS needs to integrate in the bank's technological ecosystem, right? Such that data exchange and calculations are consumed in the same fashion. So a good example would be if you think about trading, right? With the e-settlement platforms like ClearPath. We need to make sure there are no calculation differences. So the way FS, for example, would make calculations in terms of trading when it comes to cost of carry and delayed compensation and all the data elements around SOFR, we need to make sure that we also check with other vendors to make sure that they're doing the calculations exactly the same way to get to the exact same answer, because all these systems in that eco world, they have to consume the same and come to the same answer. Because if you think about it, let's say I was an agent, let's say I'm an agent, all my lenders will have different systems, right? So when I feed the lender notices or information, because they're different platforms, we all have to get to the same answer. So we as vendors have made sure to collaborate and make sure that we're getting to the same answers. And then the last piece on this slide is, in general, we know automation is definitely key. And a good example why we need to take advantage of this whole concept of SOFR and making sure that we look for any opportunities to lessen the manual work is going forward, quarter ends, and I'm speaking coming from when I used to be in the operations in the bank side, I fear quarter ends because that's when all your monthly repricing and your 3-month repricing would come due. Going forward in the SOFR world, the volume, all quarter end volume will be your month end volume, because most of your compounded loans will want to pay interest on a monthly basis, as opposed to having an outstanding 3-month rate that is compounding for 90 days, right? So because of that, we expect volumes to be higher. So one thing that people need to think about, if they haven't already, as a good example of automation, is how can we make systems, or how can we automate the process to make sure that we can read these notices, for example, and actually create the transaction in the system. And all you need is just to look at reviewing the last transaction and approving and releasing the cash, right? Because definitely we expect higher volumes when we come into the SOFR world, and the reconciliation process is going to be even more difficult, because in the LIBOR world, we had the rates set for the next 1 month. In the SOFR world, we'll see if you're using compounded in arrears or daily simple SOFR, these rates are changing daily. So that's why automation is definitely key in different pockets. So that was just an example. All right, let's go to the next slide, please. AFS has been working with market participants and gathering data to give us a good indication on where they stand in their transition, and also help us in our own planning. So with the next several slides, I will quickly share the survey findings from sometime earlier in this year. So on this slide, we're asking, is your organization's LIBOR transition on schedule? As expected, when we polled this question to market participants, more than 50% confirmed that they were on target to transition by end of 2021. Remember, that was the earlier recommendation we earlier thought that LIBOR would definitely cease at the end of this year. So most of them were on target to have it, to be able to transition by the end of the year. Let's go to the next slide, please. So later on in Q1, I believe, right? We got that extension for most of the US dollar LIBOR tenors to still extend to June 2023. So as expected, the extension of that cessation date has given most participants breathing room in terms of their transition schedule. So the good thing with that is there's therefore less panic in the market. So agent banks have more time to analyze their loans that mature after June 2023. But the good thing is most of the loans, we expect them to expire prior to June 2023. So that means less work or less contracts that need to be amended. Let's get to the next slide, please. In terms of time required to prepare and fully transition, more than 50% of those polls believed they needed more than 12 months. So therefore, this extension definitely comes in as a relief to many as they have more time for analysis, testing, and implementation. When we talk about testing, a lot of times people would think, oh, okay, so a vendor has created the system, here you go, test and implement, but there's a lot of back and forth that goes on between vendors and clients just to make sure that we can meet all client needs. So this is good, it gives us room. Next slide, please. So not all borrowers are sophisticated, right? So borrowers have been using LIBOR for decades. So introduction of a new benchmark rate and different ways to calculate interest will definitely take these borrowers some time to comprehend prior to giving sign-off for them to amend the existing credit agreements to include the new fallbacks. So hence why on this particular slide or poll, most participants indicated that they were not sure how long it would take. We expect with the extension, then there's more room for them to understand, but hopefully it's not going to hold off that long, unless the contracts expire prior to June 2023. Next slide, please. We were concerned about delays, as a vendor, and also just from our clients. They were concerned, and hence, some of them were having some little bit of panic. But we know in any project, we do assume that there are factors that may cause a delay or total shutdown of the process. But despite waiting for the final ARC conventions, because sometimes they would change, or recommendations, or the COVID-19 crisis, or the review by legal of the credit agreement language, over 50% of our participants noted that none of these were really major impediments because of impediments to the implementation of the new benchmark. So even though these factors may slow down the process, they were not a blocker. So that comes as a good news. Next slide, please. Surprisingly enough, most agent banks seem to still be in line with the ARC's recommendation to start writing new LIBOR loans by June 2021, which is next month. But once again, with the extension up until December 2021, they have more breathing room. But it's good news that earlier in the year that they were still in line to start writing new loans by June. So that means since this whole LIBOR conversation started back in end of 2017, banks were preparing for this to happen. Okay, last slide in terms of our results. So we have different variants of SOFR. So in terms of the new loans, daily SOFR and compounded in advance seem to be the most favored, because you knew the rates just like you knew the rates in advance when it came to LIBOR. And also the interest calculation was the same, right? It was just simple interest calculation, principal times rate times number of days divided by year basis, right? So they were the most favored for new loans. Also, as Meredith from LSTA mentioned earlier, now we have standalone credit sensitive rates also available in the market in case anyone wants to use them, since they're known in advance like LIBOR, and they include that credit sensitivity aspect of it, and SOFR doesn't. So if you want to use them, you can. But we believe as time goes and the market becomes more comfortable with compounded in arrears, we can expect a shift. Talking with our counterparts in Europe, it looks like compounded in arrears currently is their most preferred. And also, as with recent tone from the ARC in potentially recommending a term SOFR sooner, then we expect the syndications market to gravitate more to that rate when it becomes available. So thanks for your time, and back to you, Don.
Thanks very much. Our next speakers are two practitioners who will present their views from the ground, Jim Shanahan of CoBank and Matt Pierce of Bank of Hope, and their ongoing engagement in the transition process. I'll introduce them, and I'll also, Jim is the LIBOR cessation conversion program manager for CoBank and the Farm Credit System. He works directly with the ARRC, executive leadership, and syndication partner banks to provide clear strategy and ensure operational readiness across the entire network of customer-owned cooperatives. Matt has LIBOR conversion responsibility for loan origination and life of loan servicing activity at Bank of Hope. He works directly with executive leadership, lending units, and loan operations to ensure appropriate fallback language and conversion tactics are ready ahead of the published schedule. One thing I would note, I'll just break in for one moment, is that we did want to have time for some Q&A since we're running a bit behind. But we do very much want to hear from Jim and Matt and the concerns that they're encountering with respect to the practicalities of the transition process. So Jim, thanks.
Thanks. I'll go to the next slide. The first thing Matt and I wanted to kind of put out there is kind of a checklist of things that, we feel are really important for everyone to kind of take a look at. And the first thing is really, this is a huge project, and you need to mobilize a formal LIBOR transition program. You need to have senior people involved. You need to allocate budget and confirm staff, because this is going to cost you money and time. You need to establish program work streams. And then also, one of the critical is initiate internal stakeholder outreach as well as external for education and letting people know what's going on. The last thing you want are either customers or your own staff surprised about something. So on the next slide, the next aspect is you need to really get out and assess your exposure. Matt and I have been working on this really since 2017. You really need to take a look at an inventory of all your products. And I'll caution you, we went through everything within it, including HR, including building, and all those. People have found, 401k loans that have LIBOR embedded in it, or default interest, or on contracts, etc. So, it really does affect the entire organization. You need to also take a look at your exposure based on the new timeframes that were presented, that were formalized in March, that extend things out to June 2023. And then you need to really spend some time on your operational exposure. And Matt will touch on that more on what he's seeing there. The next thing is, you need to evaluate contracts and run through some things. There's going to be cleared swaps, bilateral swaps, that are going to function slightly different based on the proposals. You need to make sure you've analyzed those and you understand how those are going to work. You need to have communication and change management strategies for a lot of people, because this is a far-reaching aspect. So on the next slide, I just threw up kind of the CoBank plan. Again, we started in 2017. We broke it down into phases that are out there. Our phase one continues. That's kind of the consult and understand what's going on in the market. Our phase 2A was develop the operational process. Phase 2B, which we're currently in, is really the execution of that and begin issuance. We started issuing SOFR debt in 2019. We did some SOFR advances late in 2019 and really picked up in 2020 mostly to financials. And we've introduced retail products in 2021. We actually have several different flavors of SOFR-based product now outstanding. It has not been flying off the shelf for some other reasons. And then we are really looking at phase 3 is how you get through the big process of legacy contracts and understanding all that aspect. Also in phase 3, we would discontinue the issuance of LIBOR transactions except to meet current obligations under contracts and that. So, this is kind of the map out there. So on the next slide, just wanted to throw out, currently business loan customers that we're working with, they want education about this and they want to understand that, but they want an option is what we're seeing right now. We're currently seeing different flavors of SOFRs. That's SOFR loans being put out there. And you've got to be ready to adapt to those in terms of legal documentation as well as systems. One of the things that's really hurting us right now is the current SOFR LIBOR basis spreads are compressed right now and are actually less than the ISDA spread adjustments and ARC spread adjustments. So the changes in pricing makes SOFR look a little bit more expensive initially, and that's something we're running up against quite a bit. But we are working through that with customers. So the next thing is, business loan customers want to know the alternative rate. And it's creating a little bit of an issue since we still have an ARC fallback that reads term SOFR, which doesn't exist, and then daily simple average. Other fallbacks are out there, but we are seeing some folks resistant to adopting a lot of hardwired. Not everybody, but some are, and some want to align their hedges. Some or just want to keep their options open. So that's something that you got to be ready for in your thought process. If you're a lending institution and if you're a customer, you got to think through those aspects. And then, non-financial customers are looking to amend their ISDA agreements. A lot of them have not worked with protocols before, and some of that we're having to do with amendments. So that's taking time again. And then again, aligning some of that aspect with things under development is still really tough. So with that, I'll kind of stop. And I'm sorry, Matt, I kind of dominated it. I'll hand off to you.
No, Jim, thank you so much. And I'll admit I've got a little twinge of guilt because I'm the person that gets to benefit from all the intelligence and expertise of Jim and all the people who have presented so far. So my role is one where, I take this information and I get to apply it back to an organization like the one that I'm with today. As Jim mentioned, going back to 2017, CoBank was talking about this before, at least in my experience, before the topic was really popular. And so I think some of the folks who are in roles like Jim's and others who are presenting on the call, this group has been really working deeply in this space for a much longer period of time than banks like the one that I joined. And so here, we're running into the space now of really just trying to hack some of the things that Jamie talked about as a for instance, and take advantage of the hard work that, Charles, is doing with making the system, the vision system ready. And so I, Jamie, I'm thinking about that 3-step program that you put in place, and that absolutely applies to what's happening within Bank of Hope as a for instance, where we have to go back and just make sure that we've got an understanding of the situational awareness and exposure, and then the remediation effort, and then of course the execution. So the next slide, I think, is the last slide for what Jim and I had put together. And this is really just, making sure that we've got the technical pieces, assembled in a way that our operational business can handle what needs to be done. And so there's a lot of moving parts. Once we have, I think a clear understanding of what our fallback requirements are, where the risk and exposure exists, we still have to make sure that, we're operating from good data and that we know exactly what the full impact of this program is going to represent. These alternative rates are different. And I think, from my role and from my perspective, most of that responsibility in making sure that the rates are operating correctly falls to, again, many of the experts who are on this call. But once it actually, hits the operational side of things, we have to make sure that what's happening doesn't create confusion or doesn't end up in a contradictory space where, our systems and our outputs are creating some sort of a problem downstream that confuses customers and ends up, creating some sort of blowback. And then ultimately, we know that there's been some changes to what's going on with these alternative rates. Just over the past few months alone, we've seen some shifts and some more definition around the timeline. But we have to be ready to make very quick and agile responses as the alternative rates become more prevalent and as they become more precise, and we start to get some of those forward-looking index events going on. We have to make sure that we're ready to receive, ingest, and then replay that back as the market starts to demand this information. The last thing I'll say is, what we're facing at a small bank like Bank of Hope, there's not a lot of demand. In fact, there's zero demand. And so getting this into the space where the lenders are comfortable working with this and not having to rely upon somebody like Jim Shanahan to join them on a sales call is probably one of the biggest things that we've got to overcome. But then also making sure that from a legal documentary standpoint and from all the ways that we have to apply this this transition, that it becomes seamless and not a painful event for the bank operations, but also most certainly for our borrowers. So I'll pause there and see if that gives us some time back.
Thanks very much, Matt. We have some time for our questions and answers. We do have a number of different questions from the audience members, the registrants who ask questions upon their signing in. Right now, actually, from my standpoint, I'll start with that, and then I'll go to the questions and answers. So let's see. I really wanted to. I thought maybe I would start out with some general questions, which is I'll address it to Jamie Kane regarding any challenges in particular that have, or concerns that have been addressed by your colleagues, contacts, clients with respect to the issues of most concern, that is the most challenging elements of this process.
Yeah, I think the most challenging thing that I've heard lately is that it seems to be a moving target. And so for some people, that has given them reason to sort of hold back doing anything. And I think that, as I mentioned before, you can't afford to do that. Can you hear me, Don, by the way, just to make sure?
Yes.
Okay. And the things that I think of in that context are, for example, ISDA has come out with definitions for Ameribor and BSBY, and we've heard about a BSBY issuance by Bank of America. That a note that references BSBY. There's been a BSBY swap. There are some institutions that are somewhat wed to Ameribor. There's a concern about whether or not there will be a term SOFR rate, which is actually one of the our fallbacks is to a term SOFR rate. And to the extent that you don't have to make a decision with respect to your contracts until the fallback occurs, let's say in June of 2023 or July of 2023, if you look at the business days and that sort of thing, should you wait to see whether or not a term SOFR is going to be available, for example, the point I'm trying to get at is, I think some of the things you're hearing about in terms of SOFR not being a viable rate, or at least SOFR compounded in arrears not being a viable rate, in some ways are true, but they are the solution that has been recommended by the regulators. They would say it's a market-based solution, but it has been recommended, and it is the most liquid of the alternatives that are out there right now. And they do have rates that are being published and are being used. In fact, a lot of the LIBOR instruments that are out there, including derivatives, and a lot of the LIBOR debt that has been issued in what I call the second era of the LIBOR transition. The first era being when LIBOR wasn't working, nobody had the adequate fallbacks. The second era being we knew that LIBOR was going away. They came up with fallbacks, but they weren't specific recommendations by the ARC or ISDA. And then the third stage is where we are now, where we have specific fallbacks that have been recommended or are put in place. And those things that have been issued that refer to LIBOR over during that second and third era, those in many cases I think are deemed to be essentially going to be SOFR-based debt. So it's creating additional liquidity in SOFR, even though they're LIBOR-based instruments right now. And so to the extent that you are thinking about what you should be thinking about doing, obviously going to a SOFR-based rate along the lines of what ARC and ISDA have recommended or put in place makes sense. If you don't like that and you want to come up with something different, there's two things that you can do. One is, stop issuing LIBOR, stop doing LIBOR transactions, start doing transactions based on whatever rate you feel is appropriate, whether that be Ameribor, BSBY, or SOFR. Jim Shanahan mentioned, the GSEs have been issuing SOFR-based debt. It's not compounded in arrears debt; it's simple average. It's simple average SOFR. And to the extent that that's easier to use, you've got some liquidity in that market right now. That you can look to, and if you don't like what the solution is going to be, if you wait until June 30 of 2023, this is the time that you should be going out and negotiating a bilateral solution which better meets your economic needs. If you think you need something with more of a credit spread in there or that's a forward-looking type rate, you should go ahead and do that. Now, that said, keep in mind, and this is something that kind of scares me a little bit, when I hear someone say Ameribor and BSBY are just like LIBOR, that's not necessarily a good thing. To the extent that there's not adequate liquidity or transparency, and the transaction data is not as robust, as it should be, just like LIBOR didn't have adequate transaction data. You don't want to be in the same place with one of those rates that LIBOR was in. That's not to say that's going to happen, but you just need to be thinking about that. And you also need to be thinking, if I'm transitioning into one of these other rates, am I going to get the appropriate tax and accounting treatment that I'm seeking? For example, putting aside the economic impact on your company. So those are the things. That's what keeps me up right now, is that everybody's thinking there's all these other alternatives and they don't have to do anything, or they're going to pick something that may not necessarily solve all their problems, and in fact may create other problems.
Great, thanks, Jamie. That was very helpful. And kind of sliding over to the vendor perspective, perhaps a question for Charles. Can the vendor system fully support other emerging ARRs in addition to SOFR, like BSBY and Ameribor, from the vendor perspective?
Right. So as a vendor, we have to make sure that we can support all rates, right? So as we started this conversation about the transition to SOFR, already we were supporting other rates outside of LIBOR. So when the conversation started evolving from not just the 4 variants of SOFR, and we got into this whole new market of the credit sensitive rates, we looked just immediately back into our systems to see, can we already, even before the SOFR was introduced, can we support this new conversation of credit sensitive rates? And the answer was yes. Now, the only other thing was, all right, do all these new credit sensitive rates act in the same manner in terms of implementation, the calculation? So currently, from what we hear, from all that we heard in terms of how that interest calculation is, for all of them, yes, we can support that. But our ears still stay close to the market because we expect more and more rates, or rather alternatives, to keep coming up outside of SOFR to manage the loans when LIBOR ceases, so that we can make sure we are ready and set to go.
That's great. Here's a question I think Meredith may have come across, or maybe other panelists. What percentage of clients expect to use the compounding by rate interest accrual method versus compounding by balance? Is that something that you could speak to, Meredith?
Certainly, we talked about it in, I would say we've talked about it a lot in the business loans working group, the ARC business loans working group. I think there was significant, so let me break it down. I'll talk about the compound the balance versus compound the rate, and then I'll expand. I would say that there was extensive discussion around compound the balance versus compound the rate. I think that compound the balance is easier intuitively, but it doesn't necessarily fit the way a lot of systems or a lot of loans work. And I think for that reason, we spend an awful lot of time working on a compound the rate calculation. And I think to the extent that folks are, I think largely to the extent that people go compounded, the bias was toward compound the rate. Now, I need to caveat that, which is I don't know that a compound in arrears solution is what will be largely taken up. What we've heard from a number of people is that, to the extent that they use a daily SOFR, the preference was daily simple SOFR. If you look at the economics of daily simple SOFR and daily compounded SOFR are very similar. And people ask, how could that possibly be? Because, compounded should always be higher than simple. And what you're doing with SOFR is you're taking a daily rate, and that rate right now is 1 basis point. But let's say in a normal rate environment, it's 3 or 4%. You're taking that rate and you're dividing that by a day count. Now, to answer another question that keeps popping up on my screen, the ARC recommended 360 days as the day count convention in the US. In the UK, they're using 365. I don't think people are locked into doing a day count convention of 360 days, but that was, again, the ARC recommendation. You take 3%, you divide by 360 days. That is a tiny, tiny number. When you compound a tiny number, it doesn't increase very quickly. And since it doesn't increase very quickly, I mean, it increases like, maybe 1/8 of 1 basis point for an interest period, you find out that the economics of daily simple SOFR is very similar to the economics of daily compounded SOFR. You're introducing more operational risk by doing compounded SOFR. So many people decide that, frankly, if they're going to go to a daily rate, they would prefer to use daily simple SOFR. I would expand further, though, and say, but that was really, what people really wanted was forward-looking term SOFR. So there was a lot, what we saw in documentation a lot is that people would use daily simple SOFR until a forward-looking term SOFR emerged, and then they would flip forward into that forward-looking term SOFR. So one of the questions that also came through, and Jamie flagged this as well, is will we get forward-looking term SOFR? And I think the answer is yes, we absolutely will get forward-looking term SOFR. And I think we'll get it in the relatively near term. The ARC did come out earlier this year and said they couldn't recommend a forward-looking term SOFR at June 30th, 2021, and they might have trouble doing it by the end of the year. But the ARC has been moving very quickly to get to a recommendation of term SOFR. They've published principles they would use. They published indicators they would use. They're working very hard to meet those indicators. And then finally, I would say the CME has published a licensable forward-looking term SOFR that can be used in cash products. I think these are all indications that we do end up having a workable term SOFR, hopefully before the end of the year. So, Don, I think I answered 3 questions with your 1 question, but those were things that were popping through.
That was a special bonus. I think we may have time for, say, 1 or 2 more questions. This is a fairly specific one for, I think it's really an AFS question for Charles. How does AFS calculate X day look back on a daily rate when the invoice drops 10 plus days? And how can the bank cover a swap trade on an X day look back daily rate loan? That's something you can address, Charles?
I want to make sure I got the question correctly. So it's around look back days and swaps.
Yes. How would you calculate the look back on a daily rate when the invoice drops 10 plus days? And how can the bank cover a swap trade on that X day look back daily rate loan?
Okay, now from a loan perspective, right? From a loan platform perspective, we allow you to input any number of look back days that you wish, right? So on the swap side, on the ISDA side, although we're not doing swaps on our platforms, but we do understand that the conventions there, the ISDA conventions there is to have a 2-day look back with observation shift. Now, from our end on a loan platform, we can support that as well to make sure that our system would match with the other swap system that you're using. The only difference is from my understanding, on the swap side, they actually wait until 2 days prior to the due date for them to get the rate from Bloomberg that they will use for that whole interest calculation, right? For that whole cycle. But from a loan perspective, we are calculating interest on a daily basis. So when the banks are doing that analysis, because this is the question that has come up often, when the banks are doing that comparison, they need to make that analysis to make sure, because I know there will be a little bit of difference compared to how the ISDA side is doing it and how a loan side is doing it on a daily basis. In terms of that 2-day look back, as someone on the loan side might decide, no, because of billing purposes, they want to do a 5-day look back. So that causes a mismatch, right? And on the loan side, we're doing interest calculation every day. The swap side is waiting 2 days prior and then using that rate, right, that average or compounded rate for the whole period to do interest for those 30 days, just using that one rate, right? And they should, you can say they should come up to the same answer, but if you actually do the math, so far from our analysis, there's a little bit of difference. It's very insignificant, but it's up to the bank to make a decision on if they want to take that tiny loss or gain, or they want to take another turnaround. But we can support those lookbacks to match the swaps or the derivative side. Hopefully that answered that question.
Yes.
Okay.
I think that covers it from the question standpoint from our audience and registrant. And I know that we've published in the chat the contact information for our panelists in case you have any follow-up questions in any respect. I think they would be more than happy to address those questions for you and discuss any related issues. And in addition, with respect to the presentation slide deck, on the second to last page is a list of and bios of all of the panelists, and the contact information can be provided through the information on the final page with respect to all of our panelists and their organizations. So again, I think that this has been an enormously informative panel. I hope you, the audience, and our panelists as well have found it helpful and informative. We really appreciate your attending. And again, if there's anything more that we can do to help or further your understanding of any of these complex issues and the process of transitioning, you'd be happy to do so, and would love to hear from you. So again, thank you very much for coming, and hopefully we will hear more.